So Meta just reported their quarterly earnings, beat across the board, really incredible report. But the big surprise wasn't the $50 billion increase in buybacks. No, it's the fact that they suddenly announced a dividend. Yes, you heard it right. Meta is now one of your favorite dividend growth companies around. Its first dividend payout, 50 cents. Did you expect something like this? I certainly did not expect Meta to pay a dividend, at least not until the end of the decade. But I guess the company makes enough cash for it to buy back an enormous amount of shares and at the same time pay a dividend. Okay, I won't complain. Now let's start looking into this report. So I'll start with a interesting comment by Mark Zuckerberg. I call it the understatement of the year. We had a good quarter as our community and business continues to grow. We've made a lot of progress on our vision for advancing AI and the metaverse. I mean, I think right now he can talk about the metaverse all he wants because as you will see by the numbers, this business is booming and printing a lot of money. Huge contrast from the Meta of 2022. And so let's start with this quarter. Revenue came in at $40.11 billion, an increase of 25% year over year. Cost and expenses decreased 8%. And so income from operations reached $16.38 billion. That's up 156% year over year with an operating margin of 41%. Operating margin for the whole of 2023 was 35%. Then net income, just over $14 billion, up 201% year over year. And diluted earnings per share, $5.33, up 203% year over year. And if you look at the difference between 2022 and 2023, I mean, it is night and day. So for those of you that have followed the channel for quite a while, you know I was extremely bullish on Meta sub $100. I made a couple of videos about it. And to be honest, it was a no-brainer. When you looked at the scale of the company, when you looked at the cost and what just the difference between cost cutting and not cost cutting would be, the difference was immense. The risk reward was just too good to be true. We've talked about great risk reward companies lately, especially with regards to PayPal, for example. But I do think that PayPal is in a bit of a different situation right now because Meta, as you will see, I mean, if I already give you a little sneak peek here, family monthly active people, 3.98 billion. 3.98 billion, that increased 6% year over year. Quite remarkable how far these products reach. So again, when the stock was just extremely undervalued, it didn't have to do much for its business to become extremely profitable yet again. With regards to PayPal, it's a bit more complicated, but we've talked about that a lot on this channel. In this video, I want to focus on Meta and Meta only. In the next one, we're going to talk about Amazon's earnings report, which was also quite good. So if you want to stay up to date, maybe hit that subscribe button. It's free. We're going to look at a lot of companies during this earnings season. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So let's start with family daily active people that reached 3.19 billion on average, an increase of 8% year over year. With regards to family monthly active people, like we said, 3.98 billion. Daily active users, 3.11. That's up 6% year over year. And Facebook monthly active users, just over 3 billion, an increase of 3% year over year. And now the most important metric here is ad impressions and price per ad. So in the fourth quarter, ad impressions delivered across the family of apps increased by 21% year over year, and the average price per ad increased by 2% year over year. For the full year, ad impressions increased 28%, and the average price per ad decreased 9% year over year. With regards to share repurchases, so they repurchased $6.32 billion and $20 billion of their Class A common stock in the fourth quarter and full year of 2023. As of December 31st, 2023, they had just under $31 billion available and authorized for repurchases. And so they announced a $50 billion increase in their share repurchase authorization today. With regards to cash equivalents, and marketable securities, that number sits at $65.40 billion. Free cash flow was $11.5 billion and $43 billion for the fourth quarter and full year of 2023, respectively. With regards to free cash flow margin, we're around 28-29%. As for headcount, that decreased 22% year over year. Again, this was about the year of efficiency, cost cuts, and they certainly delivered. And then this came out of nowhere. They announced a cash dividend of 50 cents per share for their outstanding common stock. It will be payable on March 26, 2024 to stockholders of record of the close of business on February 22nd, 2024. They intend to pay a cash dividend on a quarterly basis going forward, subject to market conditions and approval by our board of directors. In my opinion, this is also a sign that the company is going to continue to have huge increase in free cash flow. It's not going to be a meta of 2022 anymore, where suddenly investments are increasing like crazy. There are no cost cuts, there are no efficiencies, nothing like that. Cost only goes up, margins goes down. I don't think we're going to see that ever again. Then with regards to outlook, they expect first quarter of 2024 total revenue to be in the range of $34.5 to $37 billion, which beat the estimates by around 5.5%. They expect full year 2024 total expenses to be in the range of $94 to $99 billion, unchanged from their prior outlook. And there are a couple of factors that drive those expenses. First, they expect higher infrastructure-related costs this year, given their increased capital investment in recent years. They expect depreciation expenses in 2024 to increase by a larger amount than in 2023. They also expect to incur higher operating costs from running a larger infrastructure footprint. Now, by the way, with regards to that, there was a rumor circulating today that Meta will deploy in-house custom chips this year to power AI drive. They say here the chip, a second generation of an in-house silicon line Meta announced last year, could help to reduce Meta's dependence on NVIDIA, which obviously dominated the market and dominates the market, and control the spiraling cost associated with running AI workloads as it races to launch AI products, whether it's for advertising purposes, whether it's for AR, VR, mixed reality, etc., etc. This was bound to happen. Every big tech company is going to announce their own custom chips because they're all sick and tired of paying a huge premium to companies like NVIDIA. We've talked about that a couple of times already. The fact that, yes, NVIDIA might be the number one right now, but with regards to market dominance, it might be near its peak. That's just my opinion. Going back here to number two, so secondly, they anticipate growth in payroll expenses as they work down their current hiring underrun and add incremental talent to support priority areas in 2024, which they expect will further shift their workforce composition towards higher cost technical roles, probably AI engineers and stuff like that. And finally, Reality Labs, they expect operating losses to increase meaningfully year over year due to their ongoing product development efforts in augmented reality, virtual reality, and their investment to further scale the ecosystem. Probably working on the Meta Quest 4, or maybe it's going to be named something else, and probably the next generation of AI glasses. Because right now the partnership with Ray-Ban, it's nice. It's a nice little pilot product, let's call it. But it is not really the full vision of what AR glasses should be. Now, with regards to Reality Labs revenue for this quarter, revenue was just over $1 billion, which, to be honest, is way more than what we've seen before, of course, probably driven by sales of the Meta Quest 3. With regards to operating losses, that is still quite high, $4.64 billion. Touching back on Capex for full year 2024, that would be in the range of $30 to $37 billion, a $2 billion increase of the high end of their prior range. They expect growth will be driven by investment in servers, including both AI and non-AI hardware, and data centers as they ramp up construction on site with our previously announced new data center architecture. And I mean, if we look at free cash flow, right, after all the expenses, after all the investments, if they can continue to generate above $10 billion in free cash flow each and every quarter, and maybe even increasing that in the future, this really is turning back to a money printing machine. And so, yes, they can issue billions of dollars in new share repurchase programs and issue a dividend. I rather have more buybacks than a dividend because I get taxed a lot on dividends, but okay, I can't complain. And I mean, I don't think the market is complaining either because the stock is up close to 15% at the time of making this video. If we zoom out a bit, we can see that huge V-shaped recovery here. Since the lows, the stock is now up with after hour action over 340%. Quite remarkable. And even with all of that, I don't even consider this an expensive stock as of today. Overall, very happy with this report, very surprised with the dividend announcement. So yeah, that will be it. Of course, do share your thoughts down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.